Welcome back to Switzer at Sky News Money. Okay, well, how do you live off your savings without losing sleep in a low interest rate world? That's a question, and Philip Carden of Supervised Investments Australia is here to answer it. Phil, thanks for joining us.
Thank you, Peter.
Why did you come up with this particular challenge for us?
Well, we're just looking at the customers who invest in our fund, the Supervised Global Income Fund, and the quandary they face. Some of them are self-managed super fund trustees, for instance, who may have saved, say, for argument's sake, $1 million over their life.
Yep.
And if they look
I thought they were safe with that.
Thought they were safe, and if they look at buying an Australian government bond, for argument's sake, at 2%, which is where they are at the moment, they're going to earn less than they do on the pension.
Yeah, so it's 20 grand.
Yeah, $20,000, and so you're better off without your $1 million. You're better off sort of just taking the pension, which is a bit of a quandary. We look at debt securities and relative values all around the world constantly, and there's quite a lot of good value out there if you look into the floating rate securities market.
Explain the difference between a traditional government bond and the floating rate idea.
Sure. Look, a government bond has a fixed rate of interest for 10 years. So if you buy a fixed rate of 1% or 2% for 10 years...
What are they now, mate?
Or 2.2 in Australia, 1.65 in the US.
Yeah.
If the rate goes up to 5%, well, the price of the bond goes down by, in that instance, by about 25%.
Yeah, so it's very risky over a 10-year period, isn't it?
Well, and also in an environment where we've had, and this relates to something I'm going to talk about in a sec, we've had very low interest rates for 7 years after the GFC. The effect of that on the economy has been for people to search out yield, and we think it's increased abnormally the price of assets. For instance, in the Australian housing market, if you look at the price of real estate and rent and the decrease in rental yields over the past five or 6 years, it appears that people have been investing because interest rates are low, mortgages are cheap, so house prices go up. And that effect has probably also occurred in the stock market and the fixed interest market.
It's very logical, isn't it, mate? Yeah. People love term deposits when they say 5 or 6% because there's a safety factor there. 6% on $1 million is $60,000. A lot of people think that's a good level of income to live off. 20 grand, no. So they've got to look for alternative assets, and they've gone for property, and they've gone for dividend-paying stocks, haven't they? Quite
wisely, and they've done very well out of property if they bought up until around 2012, 2013. But now what we're seeing is those assets become dangerous because in the US, for instance, the Fed's core rate of inflation that they look at is the Personal Consumption Expenditure Index. That's running at about 1.7. If we look at the...
So sneaking up.
Annual, yeah, and if you look at the last month's result, annualised, we're talking about 2.4%. Well, you can't have a cash rate at 0.5% when you've got GDP running at 1.5%, inflation around 2%, the unemployment rate below 5%. You probably should have a cash rate a lot higher. Now, if that goes up, which we think it will, as soon as this election's passed, asset prices like bonds and equities above 20 times earnings and property where yields are, 1 or 2%, which is the case in Sydney, they could be vulnerable. We're not predicting a crash. So we think...
But they'll be less popular, won't they? That's the point. If they're less popular, their share price or their asset price reflects it.
It will go down. So we think if you look at floating rate securities, when the interest rates go up, the securities yield floats up with the floating rate.
You get that.
And the capital value doesn't decrease. So we've been concentrating our...
So your fund has a lot of floating bonds or floating
100% floating rate securities at the moment.
Not all bonds. I guess you must mix up a bit of corporate stuff in there as well.
Oh, well, there's no government bonds in there. It's all corporate or mortgage related, where we have loans and bonds secured by mortgages and corporate and first charge corporate loans.
Okay, so your goal then would be to get as low a risk as possible, but with nice returns as well. And there's a bit of a trade-off always, isn't it? But you have a lot in there, wouldn't you, to spread the risk around?
That's right. That's the core trade-off. We look at asset-backed securities and having our own money invested there as well. We don't want to lose any, so we do a test. We say, what would happen if the GFC came along to this investment? Would it survive the GFC? And when we find that it does, well, then we'll go and buy those investments that can survive those kinds of stresses.
So each individual asset that goes into this fund of yours, what's it called?
Supervised Global Income Fund.
Okay, so each one of those assets are tested that way.
Oh, yes, that's our whole investment mandate.
Right, okay.
We can't buy anything that won't survive a GFC-type scenario.
Yeah, okay. Now, you had a chart which we didn't actually produce for inexplicable reason. We've got it. How's that? So the back office has just, worked overtime and got it. Now, what does this show?
Well, I think this firstly, this is a chart of the median property price in the major 8 capital cities of Australia, starting in 1985, 86, and going through to the most recent data point, as produced by the Australian Bureau of Statistics.
Yeah.
And it shows you that the long-term average increase in property is about 7.75%. But what it also shows you is the green line is the 7.75%.
That's the average.
That's the growth line.
Yeah.
Every time the annual or the quarterly prices get close to that line, the market either goes sideways or drops down a little bit.
Yeah.
If you notice now, we've gone through the line for the first time since 1985. So that's...
It kind of shows you how house prices do move in cycles.
Yeah.
And if you can bear the ups and downs, there is a nice up. But probably after that up, we'll probably see another pull away.
Well, that's why we're saying, put your money into good yielding floating rate securities, wait for a year or two, and you might see some bargains. That line, that chart might move away from that line again in the next couple of years. And then you'd move out of your floating rate or your income securities and
chase property
back into property at 4% yield again, as opposed to the sort of 2% you get in Sydney.
OK, so given the fact that we're hearing that the US Federal Reserve is getting close to raising interest rates, and we presume it'll be December, maybe Donald Trump
I think
might
December,
delay
yes.
Donald Trump might delay them if he gets up. But let's assume that. And we're also seeing even Europe and Japan kind of say, well, we're kind of sick and tired of negative rates. You get this sort of feeling 2017 might be the year of rising rates. Not big rises, but it's the start.
I feel that very strongly, because never have we seen economic statistics where they are with interest rates so low. And in fact, we don't think anybody... I was talking to someone I really respect the other day who said to me, look, no one's priced any inflation into any bond rate anywhere in the world, or for that matter, equity markets, because interest rates go up, we've got to adjust PEs and all sorts of things. I think the earnings season in the US is going to be quite good because of the growth we're seeing there, and I think that we could see some good earnings.
Average data looks better than worse, doesn't it?
Yeah, I think it looks not too bad for the next quarter, but they're going to have to adjust interest rates. And with the bond rate at 1.5, 1.7 over there, and then they push the interest rate up to 1, it becomes dangerous to hold bonds.
Yeah, without a doubt.
Well, especially if Mr Trump gets up and drops the corporate tax rate from 35 cents to 15 cents in the dollar. Yeah,
without a doubt, without a doubt. If people want to know more, mate, what's the website they go to?
Oh, supervisedinvestments.com.
OK, great stuff. All right, mate, great to see you.
Thank you very much.
That's Phil Carden.